everyone. Thank you for joining today's webinar hosted by the Global Advisory Alliance. My name is Kelly Hirsch, President of Cavalier Research, and I'll be leading today's session. Today's discussion focuses on the SBTi Financial Institutions Net Zero Standard and its relevance for Canadian institutional investors. Financial institutions are under increasing pressure to define credible net zero strategies. At the same time, expectations are evolving, scrutiny is rising, and organizations face practical challenges in translating those commitments into action. So this session is designed to provide practical insight into how the SBTi framework is being applied in the market, what validated targets mean in practice, and how institutions are navigating implementation. Today's agenda is going to include an overview from SBTi, including recent developments in the framework, an introduction to financial institution target setting frameworks generally, and insights from over 180 validated institutions, perspectives from Desjardins and Beneva, including their approach and lessons learned. And then there'll be time for Q&A. So please put your, either in the chat, in the Q&A, put your questions in. We're really hoping for a lively discussion at the end. So our objective today is to give you a clear understanding of the framework, how peers in the Canadian space are approaching it, and what it could mean for your organization. Without further ado, let's get started. And I will pass it over to the speakers to introduce themselves, and then I'll hand it over to Peter to start, and we'll go from there.
Great, thank you, Kelly. I might start with a quick introduction on the SBTi side. My name's Peter Uhlenbruch. I'm Financial Institutions Engagement Manager. And to begin with, a huge thanks to Global Advisory Alliance for hosting this session and bringing in such a rich practitioner perspective. So anyway, I lead our engagement with asset owners and asset managers globally. My background's in ESG research, corporate governance, and responsible investment advocacy. And really looking forward to this discussion today. And I'll hand over to Pendar for a quick introduction.
Thanks, Pete. I head up our financial institutions engagement at SBTi. My background is I'm a strategy consultant for most of my career. And you'll find that the background of quite a lot of people here at SBTi is actually going into business or strategy. So there is a very much of a business mindset amongst the people here at SBTi as we develop our standards. We just want to be a useful resource for businesses out there. Without further ado, I'll pass over to Nora.
Thank you, Pendar. Hi, everyone. I'm Nora. I'm the GHG Quantification and Management Advisor at Beneva. So I'm responsible within the organization for everything related to greenhouse gas quantification, decarb initiatives, and obviously the SBTi targets that we've set and recently got approved. Prior to that, I do have a background in finance, and I was working in broader sustainability consulting as well as briefly in impact investing. So super happy to be here and contribute to the discussion. I'll pass it to Catherine.
Thank you, Nora. Hi, everyone. I'm Catherine Jacques-Brissette, Senior Advisor in Responsible Investment at Desjardins Global Asset Management. So a key part of my role is really supporting clients that are committed to the transition to a low-carbon economy in decarbonizing their investment portfolios. So we do offer an integrated approach that spans the full process from measuring carbon footprint to advising clients on setting targets, such as science-based targets, and implementing practical decarbonization levers. My background is I'm an actuary, and I have more than 15 years of experience in sustainable finance, corporate responsibility, and employee benefit. And I've also served as a chair of the Climate Change and Sustainability Committee of the Canadian Institute of Actuaries. So I'm super happy to be here today to bring the perspective of an asset manager. Back to you, Peter.
Thank you so much for those wonderful introductions. Let me know when you can see in slideshow, and we'll kick off the SBTi presentation. Does that look okay?
Yes.
It looks okay, Pete.
Fantastic. So Pendar and I are going to take around 15 minutes. We're going to walk you through an overview of the SBTi. We're going to cover some recent development and insights and set the stage for the work that we've done with financial institutions over the 5 years also, and then that will lead into the rich practitioner perspective. But I'll hand it over to Pendar for the first portion of this presentation.
Yeah, thank you very much. So for those who are not familiar with SBTi, SBTi is a charity that was set up around 10 years ago, just over 10 years ago. In the UK, it was an initiative that was born out of WWF, UN Global Compact, WRI, and CDP. And over time, we became an independent legal entity in 2023, and we set up a fully owned subsidiary called the SBTi Services, whose job it is to essentially do the conformance assessment when companies set their targets according to SBTi standards, tools, and guidances. And earlier on this year, SBTi became a member of the ISIL community. And for those who are not familiar with ISIL, is a membership organization, and it defines basically and promotes good practices for sustainability standards development. Going to the next slide. So we have just over 13,000 companies that are either validated by SBTi or committed. Of those, you will see that over 10,000 are validated, and just under 2,500 as at the end of Q1 had net zero targets in the corporate sector, with just under 3,000 committed to set targets. In the terms of financial institutions, we have 185 that have been validated by SBTi, with another 140 or so committed to set net zero targets with SBTi, which is somewhat of a different standard, which Pete is going to come to and explain in a minute. In our corporate sector, so if you strip out financial institutions and small to medium-sized enterprises, so kind of the bigger companies in the world, you will see that we've been having a very rapid rise. And in the light blue, you will see the uptake in the net zero standard. The ones in purple are near-term targets with SBTi, near-term only targets. And they've been on the rise across the board, and we grew in terms of overall targets by 46% during the course of 2025 against all the negative background noise about ESG. Going to the next slide. And if you kind of have a look at where we're getting traction around the world, the biggest base of validated companies is Europe, which grew by 43% during 2025. The second biggest base of companies with validated targets is Asia. And a lot of that has been driven by supplier engagement targets. For example, if you have a very big company like a Walmart, and they set a target to reduce their inventories, they're going to go to their supply chain partners all around the world, in Asia, for example, and they ask their suppliers to reduce their targets, and the suppliers in turn set their own targets to demonstrate. And then when we look at North America, is the third largest base in terms of companies with targets. Interesting to note that the rates of growth during 2025 in Europe was 43%, and in North America was 41%. So it's pretty much level pegging. So this pace of action in North America has not slowed down a ton. And if you look at below the kind of the bottom part of the map, you will see in LATAM, Africa, Middle East, and Oceania, the base is lower, but the rates of growth span somewhere between 40s and 50%. Passing it over to Pete.
Thanks, Pendar. Now, I'm zooming out to the world's largest companies based on an analysis of the world's largest 2,000 companies. The SBTi, I think it's safe to say, has become normalized and mainstream. We now have over 40% of global market cap covered by science-based targets. But according to these figures, if you look at the revenue to market cap ratio, it's a lot stronger for companies with validated targets. So we think investors are really taking a validated target as a seal of approval for companies who are credibly managing their financially material ESG risks. Looking at stock market index penetration across the G7, we've made a lot of progress, particularly across France, Germany, UK, Japan, US. And to a degree in Canada, across the TSX 60, we've got around 30% covered by targets or commitments, but there's still some way to go, and certainly financial institutions have a key role in incentivizing companies to come along on the journey. And one of the major reasons we hear from companies when they come to the SBTi for validation is that they're hearing it from their investors. So it's a really important lever for action. This company just highlights the countries with the highest numbers of validated companies. You can see Canada is here, although it is on the tail end. So again, room to sort of flex some investor influence and make some progress. But you can see the higher uptake in some of the other countries. One of the big themes we've seen pop up in the last 18 months is a real return to making the business case for sustainability action. And we published a report last November, which was a real deep dive into the evidence, positive evidence for setting science-based targets. The SBTi conducted a survey with over 170 companies that had a target for 2 years or more, asking about the business case impacts. And there's a lot more information in the report, but just some key takeaways. Over 90% of companies reported overall a positive impact on their business. When it comes to strategic outlook, 80% reported having a target was beneficial for future-proofing their strategy and their business models. So with a transition plan hat on, that's quite powerful. And again, the 3/4 of companies reported stronger investor confidence on the back of having a target. So some quite compelling evidence here to take away. Now, a little bit more about SBTi and how our standards are evolving. They're evolving towards a modular structure. So Pendar mentioned the growth in the corporate net zero standard. We have that covers operational emissions and scope 3 categories 1 to 14. That's undergoing a major update at the moment. We now finally have the net zero standard for financial institutions, which covers scope 3 category 15 emissions. These are our 2 flagship cross-sector standards underpinned by methods and pathways. And for companies in the high emitting or hard to abate sectors, we have sector specific guidance, which you can see on the right hand side there. This year is going to be a very big year for SBTi, as we'll be publishing the version 2 of the corporate net zero standard. Now, this slide would probably deserve its own webinar. I'm not going to go into detail, but there are going to be some really important updates that are going to help companies move from ambition to action, and the new standard will provide more flexibility and more practical ways to address emissions for the different sectors and regions in which companies operate. So some quick examples. These examples come from the second consultation. It's not from the final standard, but it gives a good direction of travel. Targets for scope 1 and 2 are proposed to be separated out. And for scope 3, which has historically been the biggest challenge for companies, there's a proposed revised approach for target boundary, focusing on priority emissions, as well as a wider menu of target setting options. So keep an eye out for that. So our work with financial institutions, we currently have 2 target setting frameworks. We have since 2020 the near-term criteria, and we've had now well over 180 financial institutions, including Beneva and Desjardins, who are going to share their experience shortly. But we also have the net zero standard, which was published just in July last year, and we've just had our first validation. So if you go to our target dashboard, you can see who it is. And I'm going to talk a little bit about some of the similarities and differences between these frameworks, but they currently both remain target setting options for financial institutions. The near-term criteria have been around since 2020. They cover lending and investing, so very much on the asset side, with a 5 to 10 year target time frame. And for this framework, there are 4 eligible target setting methods. I'll quickly run through them because I think they're going to set the stage for further discussions. One is portfolio coverage, which commits to increasing the share of companies in the portfolio with validated targets with SBTi. We also have temperature rating, which uses a methodology to input any kind of public climate target, which then the output is a temperature rating score. Both these target setting methods are intended to be engagement-led targets. So they're to identify hotspots and inform engagement and action to encourage the portfolio to decarbonize. The third option is sector decarbonisation approach. These are emissions intensity reduction targets based on sector-specific pathways. And since the major update of this framework in 2024, we have a fossil fuel finance option for addressing fossil fuel emissions. So that's the target setting menu, so to speak. and they're used to cover the minimum coverage requirements, which you can see they're listed, but I won't go into too much detail about this. So what kind of financial institutions have been setting targets with the SBTi? Well, it's a pretty good mix. Not so much of a surprise, we've seen the strongest base in Europe with around 70%, but around 20% is from Asia, and we've had quite a strong uptake, particularly from South Korea and Taiwan. And a little bit more limited uptake across North America. Hopefully that might change after this webinar and a little bit more sort of peer level sharing, but we certainly would welcome more financial institutions from North America to consider taking target setting action. And in terms of the spread across financial activities, again, it's a pretty comprehensive mix. We're seeing the strongest uptake from banks and private equity, but also quite strong uptake from asset owners and asset managers. So this is proof of concept that the target setting framework is applicable across the financial systems landscape. I thought it would be fun to do a little analysis of, well, what are the most popular target setting methods for the near-term criteria? And portfolio coverage is the most popular, followed by sector decarbonisation, and then in turn by temperature rating. But they all get quite a strong uptake. So again, it's possible to use a mix of these targets across asset classes so long as they're used consistently. But they've had pretty good uptake across the board, except for the fossil fuel finance, which has been a relatively newer target setting option. This slide, the point of this slide, it shows how many financial institutions with a validated target are also involved with other peer target setting initiatives for financial institutions. The point of this slide is that SBTi targets are complementary with other target setting initiatives and not mutually exclusive. So across the GFANZ initiatives, we've seen quite some overlap also in the private equity space with ICI. So I think that's important to reiterate. Now, moving on to the financial institutions net zero standard. I won't go into tremendous detail. It's quite new, but there are some important developments and evolutions that I think are worth highlighting, that I think are really relevant to financial institutions who are trying to figure out how to evolve their target setting looking forward. So the first key point of departure is that it increases the scope of financial activities that are covered. So lending is still there, investing is still there, though it's split into asset owner investing and asset manager investing. And that's a dynamic we can kind of explore on this call today, potentially a little bit different, as we have an asset owner and an asset manager on the call to share their experiences. But we also have insurance underwriting and capital markets activities. So it's a one-stop shop where all these financial activities can now be covered under the same umbrella. This slide shows the conceptual framework of the net zero standard, and you'll see in red, that nice little arrow that sort of scoops up. That's the leading indicator within the net zero standard, and it's all about portfolio alignment. This is all about near-term action. So under the standard, financial institutions are required to set long-term portfolio climate alignment targets, which is going to increase over time. And they can capture a range of different financial activities. Firstly, companies already operating at a net zero state, but there aren't many of those at the moment. Secondly, capturing companies that can demonstrate that they're in transition. So it's very much about scaling transition finance, and I'll explain what this means in practice in a minute. And thirdly, it's about incentivizing investments in climate solutions. And we've certainly seen a lot more climate solutions target in the landscape. And I'll speak about what this means in practice in just a minute. There's another way to also determine if a company is aligned or not, and that's through using eligible sector benchmarks within the standard to benchmark performance. You'll see the line going down, the dotted line, that's portfolio emissions. Now, the good news is that there are no targets on portfolio emissions. It's really there to help improve the quality of the data over time, so that by the time a financial institution gets to net zero in 2050, they can make a credible claim that they've reached that important milestone. But financial institutions certainly do need to improve the scope and quality of that over time, and I think rightly so. So the big question for financial institutions under FINS is, how can they tell whether they, the counterparties they lend, invest or insure are climate aligned? And alongside the standard, we published this critical document called the implementation list. And this is where the SBTi really opens the doors to eligible target setting methods that can be used in the context of the standard. So to help identify what's in transition, we have 13 eligible methodologies, including SBTi, that can be used. That's a range of commercial and non-commercial providers. And these methodologies have all gone through a credibility assessment. They've satisfied quality criteria. So it's a really good list of methodologies that can be used. And for determining climate solutions, we've introduced eligible taxonomies at different levels, whether they're regional, country, or global level, that can be used to identify climate solutions that count towards targets. So this is a big leap forward in terms of interoperability. I'm going to move, in the interest of time, pretty quickly through the structure of the standard. There's quite a lot in it, and there might be scope for a follow-up webinar to go a little bit deeper into FINS itself. But a few key points. Firstly, the standard is structured around the net zero journey for financial institutions, beginning with the commitment, moving to a base year assessment, and then into target setting, reporting, and renewal stages, which then feed back into the assessment phase after 5-year near-term periods, and that cycle repeats until 2050. So it's a really nice end-to-end cycle. There's also a wider range of data points that financial institutions need to collect and report on the net zero journey. And the net zero standard introduces policies alongside target setting. So the policies is a new area that's not in the near-term criteria. And it's essentially around 3 areas. Firstly, it addresses new financing of fossil fuel expansion. The second policy area addresses deforestation. And the third policy area identifies real estate. So that's important to highlight. In terms of target setting, there are still near-term targets, but there's flexibility between alignment targets and sector targets. So there's still a fair degree of flexibility and choice for financial institutions in the near term. But in the long term, there are required portfolio alignment targets, which I've mentioned. And the final point I'll make before wrapping up on the SBTi presentation is that the FINS standard also provides deeper regional calibration. So that's across 3 areas. For alignment targets, there are different milestones for developing versus developed economies or countries, just to make sure that developing countries have a little bit of extra buffer to align. Secondly, around mandatory phase-out targets for coal, there are different timelines for OECD versus non-OECD. And the implementation list I just mentioned includes some great taxonomies from emerging markets, which can be used to unlock climate solutions. So that's just a flavor of how the net zero standard is taking a bit more of a stronger account of regional differences. And I think I'll stop there. Look, that was a helicopter view of SBTi, as well as the near-term framework and the net zero standard. But I believe we're going to move now into, I'm really looking forward to this section, which is going to be around how financial institutions are going with having set near-term targets under the existing near-term framework. So I might move on. I'll hand the microphone over.
Hi, thanks, Peter. No, that was great. I mean, as someone, I was very involved in stewardship with Canadian financial institutions, and so it's really good to see these developments. I can see how helpful they'll be for investors in evaluating company in some of the areas that are a bit harder. But with that, I'm very excited to hear from Nora at Beneva, and just sort of hear some of your experiences with it. So I'll pass it over.
Thank you so much, Kelly. And thank you, Pendar and Peter, for the overview of SBTi standards. I think it's really helpful to just get the discussion going. So I'm going to share Beneva's journey with SBTi on the kind of the asset owner perspective. So I actually, before this webinar, I went to check the dashboard again, and I noticed that only, aside from Beneva and Desjardins, only one other financial institution in Canada has committed to the SBTi. So really happy to be, participating in this really important webinar and spreading the word about SBTi, and hopefully more companies can be incited to join. So Before I get into our journey, just a little bit about Beneva. So Beneva is the largest mutual insurance company in Canada. We offer group insurance, property and casualty insurance, health and life insurance, as well as savings and investments. So services. So as a mutual organization, our mission is clearly, tied to long-term value creation, both for our members, our clients, and society as well. So the long-term perspective was really important to us because it's actually what drove us to commit to net zero and to commit to the SBTi targets. A bit about our investment structure, just so we can understand, to explain what we actually control. At a high level, our total balance sheet assets are split into general funds, client funds, and other assets. And of the general funds, 81% is internally managed and 19% is externally managed. And the boundary of our targets are really only applying to general funds. So even though there's some part of this that's externally managed, we really wanted to use these targets, as Peter said, in a way to engage asset managers and hold them accountable through different expectations and maintaining dialogue with them over time. Briefly wanted to touch on our targets. So we do have our corporate target on absolute scope 1 and 2 emissions. And for our portfolio targets, we have 3 intensity-based targets on our mortgage, real estate loan, and commercial real estate investment portfolios. We also have a temperature rating target on our listed equity and corporate bonds portfolio. So a mix of everything that we decided to engage with. So next I'm going to share, just deep diving into our journey with the SBTi. So in 2023, Beneva decided to register with SBTi and commit to submitting a net zero target and to align operations to net zero. At the same time, we already had set clear our net zero ambitions in our impact report. So to be net zero by 2040 and net zero in 2040 in our operations and our general funds, and net zero 2050 globally across the organization. So from the start, we knew we wanted our net zero ambition to be grounded in science, to be credible, and to be aligned with recognized international best practices. So I wasn't personally part of the team when the initial decision was taken, but I know that there was a lot of discussions internally about how and whether we should commit. So at the end of the day, we did decide to join SBTi, and ultimately this was for a few different reasons. So first of all, transition risk management. So SBTi really helps translate climate science into concrete financial signals, and those are essential for managing long-term investment risk. Next, alignment with industry best practices was also something we wanted to have, because we think it's really important to be able to compare across different companies and not really have customized metrics. It's important to have, kind of apples to apples targets when we're comparing each other across the industry and as well other sectors. And as well, alignment with our net zero objective was really important because it gives us a clear structure internally and some milestones to an ambition that otherwise could have remained scary or a bit abstract to have concrete steps towards reaching. And lastly, avoiding greenwashing and managing reputational risk is a big one. So using a clear, defined, renowned methodology really helps in reducing the risk of overstating progress or understating it as well, especially as the expectations from different stakeholders continue to rise. So with these steps in our journey and how, the reasons we wanted to join, there's also been a few key challenges that I wanted to highlight. So it's important because I think a lot of you on the call today will recognize them as, Canadian institutional investors. So firstly, I wanted to briefly speak about Canadian regulations, because in Canada, as we know, the landscape is still evolving. So, as an insurance company operating in Quebec, Beneva is regulated by l'Autorité des marchés financiers, AMF, which they've issued a climate risk management guideline that's aligned with international disclosure frameworks such as ISSB. And that's really been great. And it creates more clear expectations for insurers when it comes to identifying and managing climate related risks. However, there's still many sectors that are not yet subject to regulations, or at least on the same level as with IMF. So that's including parts of the investment value chain that we depend on as asset owners. And at the same time, the Canadian Securities Administrators, CSA, decided in 2025 last year to pause the development of their mandatory climate disclosure rules for public issuers, which again adds some fragmentation to the market. So while we were able to commit to SBTi and be regulated as an insurance company, achieving a credible transition really requires more than just that. It's just collective action across the financial system and not just efforts from regulated institutions alone. Moving on to some of the other challenges we faced. So we started this work with the SBTi in a politically sensitive context. There's been some backlash against climate-related policies, particularly in North America. This made engagement with external asset managers a bit more difficult when we wanted to obtain data from them and such. And at the same time, we saw industry players that were stepping back from their commitments, and we had to stay firm and confident in our positioning and in our commitments, even though this environment was shifting. Next is a really big one as well, data availability from internally sometimes and from external managers most of the time. This still remains one of the biggest challenges in the industry across not just the work to decarbonize, but any work in sustainability and setting targets. So internally managed assets are much easier to obtain data from than externally managed ones. And that's something we faced as an asset owner as a key challenge. And finally, aligning SBTi requirements with what we already had internally in terms of responsible investment policies it's still requiring some real coordination between our different teams. And the important message that we have to, give to the teams is it's not just about adding a target, it's really about connecting everything coherently and all working towards a common goal. So one of the most concrete benefits of having near-term targets validated is that they were able to translate ambition into action for us. It's supporting the implementation of our transition plan, and it's really creating clear signals for our investment teams. So now instead of asking, are we aligned with net zero, we can just ask, okay, how does this specific investment decision move us towards or away from our near-term targets? That shift was really important to state in the different teams because it really brings this climate consideration into day-to-day decision making and not just a long-term strategy that's like kind of in the future to achieve. So looking ahead, a few next steps for us in at Beneva is really we set up working groups to align investment teams with the different targets that they can directly influence. We're clarifying our positioning on fossil fuels, and we are continuing to work towards submitting our SBTi net zero target with the new fin standard next year. So overall, I would say, SBTi doesn't give you all the answers to all your problems, but, it's really all about giving you a direction, a structure, and a shared reference point across the industry, and obviously engagement, collaboration among peers, and mobilization. Thank you. I'll pass it back to Kelly.
Great, thanks, Nora. That was I really like that. Sort of each decision is this moving us towards or away? I think that's a very useful tool. I think when to get it sort of really embedded in operations. So really great to hear your perspective. Just a reminder, everyone attending Q&A throw some questions in. We're going to have a great chat at the end. But with that, I'd love to hear the asset manager perspective from Catherine at Desjardins. So I'll pass it over, and yeah, excited to hear.
Excellent. Thank you, Kelly, and for the whole organizing team to set up this important conversation. And thank you also, Nora, for sharing your perspective as an asset owner. It was super interesting to see how the many similarities that we and the challenges we're facing and the benefits as well. So I'll try to bring a complementary perspective from an asset manager point of view. So before jumping into the concrete SBTi targets, let me briefly introduce Desjardins' climate ambition to sort of clarify how our asset management role comes into play. So Desjardins Group, which probably all have heard of, is the largest financial cooperative in Canada, and it has diversified business segments, including traditional banking activities, but also insurance companies and asset management services, such as those provided by my employer, Desjardins Global Asset Management, or what I'll refer to as DGAM. So at DGAM, we manage institutional mandates on behalf of clients, including Desjardins insurance companies. So Desjardins Group, the parent company, is committed to net zero and has set near-term targets, science-based targets that have been validated by SBTi. And some of these near-term targets cover the investment activities of Desjardins insurance companies, which are implemented through DGAM. So that's where we come into these SBTi targets by decarbonizing the portfolios of our insurers. So for starters, why has Desjardins Group decided to join SBTi in the first place? Well, very similar to Beneva, so I'll be very brief on this one. But from an asset manager perspective, as Desjardins Group, we have a strong climate ambition, and we aim to do our fair share in the global path to net zero. So that goal is fully aligned with a commitment to SBTi. And now, after the initial commitment, comes in the target setting. So the SBTi targets provide a really concrete way to sort of translate the long-term net zero ambition into measurable near-term objectives. And finally, the independent SBTi validation ensures that the targets have a scientific credibility and also an alignment with global climate goals. So from an asset owner perspective, SBTi really helps closing the bridge between net zero ambition and measurable targets. And now moving back to the asset manager perspective. So what value does it create for us to work with clients that have science-based targets? So at DGAM, working with early adopters of SBTi targets, such as Desjardins insurance companies, it really has fast-tracked our ability to build the expertise that's needed to implement these ambitious decarbonization targets. And now that we've built that expertise, it's now scalable. So we leverage it across our broader client base, both in advising clients on target setting, but also by deploying concrete decarbonization levers in their portfolios. And finally, SBTi validation has also strengthened our credibility. On the one hand, with clients by positioning us as a leader in climate and really showing that we have the expertise to decarbonize our portfolios. But also with portfolio companies that we engage in, but by ensuring that what we ask from them is fully aligned with our own decarbonization commitments. So we really walk the talk, basically. So for asset managers, SBTi really helps translating ambitious targets into practical decarbonization within the portfolios. So then in practice, what does portfolio decarbonization look like? So our approach to decarbonization is really based on a range of complementary levers that each are adapted to the objectives of each client. So the first lever is ESG integration. So that basically means that company analysis combines traditional financial metrics with material ESG criteria, such as carbon footprint, targets, and transition plans. The second one is screening. So on the one hand, we have positive screening, or are often referred to as best in class, which involves selecting investments based on defined criteria, such as companies with the best climate performance in the industry. And on the other hand, negative screening or exclusion mean excluding certain investments based on defined criteria again. For example, excluding issuers in the fossil fuel sector that do not have an adequate transition plan. And thirdly, we have stewardship, which is also referred to as active ownership. It's really a transformative driver that's super important to our strategy because it encourages company to adopt better client practices. So that includes shareholder dialogues, which means engaging with issuers to gain a more comprehensive understanding of their climate strategy, but also to make recommendations to strengthen it. And it also involves exercising voting rights, which means using proxy voting to encourage companies to adopt and implement strategies that align with climate change mitigation. So, for example, that could mean voting in favor of resolutions that support credible transition plans or emission reduction targets. Or, on the other hand, voting against climate strategies that are misaligned with 1.5-degree pathway or lacks clear implementation. The fourth lever is thematic investing, which involves allocating capital toward green and sustainable instruments, such as sustainable bonds or renewable energy infrastructure, for example. And finally, collaboration, because we firmly believe in the power of collective action. And we approach that in several ways, be it participating in investor initiatives, engaging with public policymakers, raising awareness in the financial community, and also supporting research and education to the next generation. So all of these individual levers are individually effective, but they are far more impactful when used together because they reinforce each other. So when thoughtfully combined and tailored to client objectives, they can become really powerful drivers of capital toward a low carbon economy. So, of course, implementing science-based targets, which are very ambitious by definition, is much more easier said than done. So what are the key challenges in practice from an asset manager point of view? Well, there are many, as this is a very complex endeavor, but I've tried to synthesize the main ones into 3 categories. And these are really connected to the same challenges asset owners are facing. So data, once again, because you can manage what you can measure, right? So to measure the carbon footprint of a portfolio, we need to access emissions data from portfolio companies. And that data is often incomplete, inconsistent, or lagged. So that leads to increased reliance on estimates and modeling, which adds uncertainty to the results. So these data limits adds a layer of complexity to the measurement, tracking, and progress assessment of targets. Secondly, other existing portfolio construction constraints that are also a challenge. So when we integrate decarbonization objectives into portfolio construction, it requires a rigorous balance between all of the other investment criteria that you can imagine, such as fiduciary duties, risk return profiles, and diversification requirements, among others. So it also requires avoiding unintended outcomes, such as excessive divestment, which may reduce portfolio level emission when you look at, for example, a sector level target, but that merely shift emissions elsewhere, basically in the economy, rather than making real world decarbonization. So ultimately, achieving meaningful decarbonization without compromising portfolio objectives really requires a careful calibration between investment decisions and decarbonization levers. And last but not least, the dreadly headwinds that we're facing these days. So ultimately, portfolio decarbonization really depends on the pace of decarbonization in the real economy. And that progress is being slowed down in several ways, such as geopolitical uncertainty, anti-ESG backlash, and regulatory rollback. So that really highlights the challenges that investors face in driving emissions reduction without corresponding real-world transition. So in summary, ambition matters, but implementation is really shaped by real-world constraints. So recognizing these challenges is really essential to driving credible decarbonization over time. Sorry about that. My first slide was not showing up. So to end with sort of key takeaways, key lessons. So what have we learned from implementing science-based targets in practice? So again, trying to synthesize in 3 key messages. So the first one would be that decarbonizing portfolios, is not a one-off exercise. It's really an ongoing long-term journey. And as data quality, methodologies, and market conditions continue to evolve, the way we implement decarbonization targets must adapt accordingly. Secondly, science-based targets cannot work in a silo. They must be really embedded into day-to-day portfolio management, because ultimately, asset managers are the ones that are making the portfolio construction decisions that drive the outcome. So in order to ensure that decarbonization objectives are considered alongside the other investment constraints that I mentioned earlier, a close collaboration and alignment across teams is required. This in turn calls for strong governance structure to ensure accountability for meeting decarbonization targets. So that includes, for example, incorporating portfolio decarbonization targets into the client's investment policy, but also linking these objectives to incentives or compensation measures can further support effective implementation, as we do at DGAM. And third, one of the levers I mentioned earlier, stewardship, it really plays a critical role in influencing company behavior to drive decarbonization. So through engagement and voting, stewardship allows investors to encourage companies to set credible targets, strengthen governance, and align capital allocation with transition objectives. So this is particularly important, especially in situations where divestment alone would not be effective. So in summary, I would say that our journey really underscores that credible portfolio decarbonization is built over time through adaptation, alignment across investment teams, and active ownership to deliver real-world results. So I'll pause here and look forward to the Q&A.
Great, thanks, Catherine. No, it's really good to hear just a bit about. I really like that balancing the different, sort of different aspects and how sort of SBTi can help sort of do that. It's an incremental progress. But thanks everyone for the questions that have already been put in. Feel free to try to get yours in. I'm going to go through, try to get through as many as we can in the next, 12 minutes. But so just to start, in transition is a very broad climate alignment category. Is SBTi looking to make this more granular in the future? As Peter Pendar, I'm assuming, would be the...
It is fairly specific, really. So, I mean, you can look at a company that is quoted or public or private, and you can actually say, but is it actually, does it have an alignment status or not? So, for example, one could be, does that company have a validated science-based targets? Or does that company have a certification according to Climate Bonds Initiative, if you're using the FIN standard rather than the near-term standard? So, or you can actually go to the temperature scores and actually look at the temperature score of that company and see its own stated climate targets, are they ambitious and meet the requirements of the pathways or not. So it is actually fairly specific. In certain instances, it can be intensity based, and the intensity based is particularly popular amongst banks, or it can be identified through taxonomies, eligible taxonomies. And so, for example, if something is taxonomy, and that's probably maybe even easier if you're a bank or an insurance underwriter, then even in an emerging market, you can apply taxonomies and find your solution there and overcome some of these data challenges that there are.
I can just add one thing to Pendar's response, is that the eligible alignment methodologies in the implementation list, which is one of the main ways to identify in transition. Right now, it's really based on ambition and forward-looking plans, but I think that the idea over time is to sharpen the criteria, so that's more focused on performance. So as the standard evolves and we move closer to 2050, so will the expectations about what in transition means. So that doesn't answer the question about being more granular, but maybe it does about becoming sharper over time. What transition means is going to change, and the standard will evolve to meet that.
No, it's great. Yeah, no, great to hear that. So it's always incremental improvement is generally how we're actually how you actually achieve something. So next, so this would either Nora or Catherine, or both, if you both have input. So how did you achieve executive buy-in for SBTi? Given the headwinds with industry players, stepping back. Just last week, the two big Canadian banks sort of said back from some of their objectives. So yeah, I'd be interested myself to hear too.
I can go first on that one, maybe. So I think I'll start by giving like not a real answer, and then I'll give my inputs. At Beneva, we're really lucky that, we have an amazing practice leader that paved the way into like the executives to, just get the buy-in on climate in general. So I think that really made it easy. And I think how, it was able to be sold to them in a way is to just emphasize that we're an insurance company and that we're a mutual, and anything, like there would be no more insurance company if there's no more like proper climate. So that's pretty much the leading message, I think, that got our executives to buy into this applying to SBTi. And I mean, I know that regardless of all the noise, that's essentially what it is, it's a lot of noise. I don't think it's changing anything long term in the industry's commitments. I think a lot of players are stepping down just based on current very short term noise. So just to push through and remember what we're here for, what we're actually doing it for. And yeah, I guess that's my 2 cents.
I can provide also a little bit of insights. Although I wasn't at Desjardins back then when it was the targets were set, I did the same back when I was at Bell from a corporate perspective, and I think it goes down to a very similar thinking as you, Nora. I think it's really important to put it as a risk, putting it from a risk perspective, because and it's the same when we engage with portfolio companies. I mean, whether you want to convince your executive to set ambitious targets or convince other portfolio companies to do the same in their business, it really has to go down to what's financially material, and climate risk is financially material, be it for transition risks and physical risks. And although transition risks may seem less relevant in the very short term, it's still relevant in the mid long term, and physical risk is even more relevant as with all of the pushback and all of the commitments getting dropped. So, and being also a company in a financial institution involved in insurance, we're at the forefront of the impact of climate change. We're seeing it like over the past 10 years. We've seen the biggest claims especially in property and casualty. And I always remember a famous phrase that was pronounced by I think it was Henry de Castries when he was the CEO of AXA back then, and he said that a 2-degree world might be insurable, a 4-degree world certainly would not be. So like that really puts into perspective our whole business. So I think framing it as from a risk perspective really helped to get the message through.
Oh, great. Thanks. Yeah, I've always thought insurance is one of those areas, like the financial impacts are so direct. The next question is very similar, just maybe if you want to touch on, just sort of, was there any opposition, because we sort of phrased it from the other, was there any opposition that you faced, sort of as you were going ahead? If there's sort of any thoughts, that's okay. I can also want to make sure we get through as many questions as possible, so.
Well, my thought on this is that back when I was again my former experience, we did experience some pushback, and I think it goes down I think a little bit to my message on how how you implement targets when you actually get there, both is the same. It's a long-term process and iterative process, and really it's really important to be persistent and get your consistency, push your message forward, and with time and with again an iterative process. That's how you end up getting buy-in from leadership for setting targets, but also with portfolio managers and all teams involved to really end up with real world result at the end of the day. So we really need to be patient and persistent in that process.
Maybe I'll jump to so with the new standard with climate solutions. So here's sort of a theoretical question. So if an FI sets a climate solutions investment target in absolute terms, sort of how is this target, like commit 100 million to climate solutions? How can this target, sort of be captured under the standard?
I might have a quick first go at this one. So great to see those targets. So the way it would work in practice, say of that 100 million, as those investments are made over time, so long as those investments satisfy eligible taxonomy criteria in the implementation list, then those investments would automatically count as being aligned. So you can have an alignment between like an intentional goal to scale climate solutions, and as you go, so long as you're financing eligible climate solutions, they count towards long-term portfolio alignment targets. So in this way, you can kind of have these as separate standalone climate solutions targets, and as they're realized along the way, so long as it's aligned with taxonomy criteria, then they count to alignment. That's how I would probably look at this, unless Pendar, you have anything else to add around it. But it's a great question.
Yeah, I think my take on it is that if you actually look into eligible taxonomy, there are hundreds of different types of things that you can actually invest in. For an asset manager or asset owner, it might be a little bit more difficult insofar as you might actually say, I'm going to be financing as a pension fund, for example, a renewable power generator, or kind of a utility scale or something like that. But it is very, very relevant. Even if you're, for example, know what's the alignments of hundreds of thousands, but you know that, am I lending against rooftop solar? In that case, yes, that counts. Am I lending towards electric tree shows, for example? And that does count. So it doesn't matter which geography you are, you just know very quickly whether putting your money into something that is taxonomy aligned is a good thing or a bad thing. And actually I had an aha moment when I was delivering a 2-day session really for financial institutions in Bangladesh, and the CEO of Citibank, not Citibank as in US bank, but the big bank in Bangladesh, basically the CEO stood up and said, look, we love lending to this type of businesses because the debt often doesn't go bad. That's why as a bank, they said that they had the lowest bad loans in the industry in Bangladesh. So it's generally good business to do, and taxonomy is kind of very broadly applicable. But you can look at it through different lenses. You can look at it through an entity lens. You can look at targets through intensity lens. So you can look at it through a tax.
Okay, great. I think I think you just broke up there, but sorry. So I think though, I'm looking at the time. I know we didn't get through all the questions. We'll try to, if we have your contact here and name, we will directly respond. And then as well, always feel free to reach out to sort of any of us, and happy to answer. But thank you. Like all the panelists, super interesting conversation. I learned a lot, and I hope everyone else did too. Thanks again to Global Advisory Alliance for hosting this, and I hope everyone has a great day.